As we approach the end of this course, public administrators should be able to speak intelligently concerning our nation's fiscal and monetary policy. This module is designed to provide an overview of these areas and the associated terms. Not everyone agrees on which policy is the best for our nation. That is a matter of the will of the electorate. What is important here is that public administrators know the policies and terms. Fiscal policy can be broken down into two main areas. Those areas are Keynesian and SupplySide Economics. Keynesian economics is from the school that believes government can control the status of the economy through tax rates and government spending. That is, pumping money into the economy. While SupplySide Economics is from the school that the private sector is better suited to stimulate the economy and the country's growth through increased business, mainly possible through decreased tax rates and government interference. The nation's fiscal policy is either in place to prevent or help the nation out of a recession. This is a decline in the economy, usually lasting more than 6 months. A little slowdown from time to time is normal and can be considered part of the business in our country. It is not unusual for the Federal Reserve to reduce interest rates during these periods to help the economy move forward. Economic growth would be considered the opposite of a recession, where growth is going very well, and it may be necessary for the Federal Reserve to raise interest rates to cool down an overheated economy. This is done to prevent high levels of inflation. Our country's overall economic health is measured by the gross domestic product, GDP. The GDP is determined by what citizens in a country consume in goods and services, consumer spending, government spending, a country's investments, and net exports. Net exports is determined by how much a country exports minus what the country imports. In the United States, monetary policy is determined by the Federal Reserve. The Federal Reserve is a central bank in the United States with 12 branches throughout the U.S., run by a governing body that literally determines the amount of money that will be in circulation and the interest rates charged for borrowing this money.